So we have Darren. There you go. Co-founder and CEO of IPOR Labs. It's going to talk about a lot of interesting things, like how institutions can allocate on-chain without triggering the regulator, which we definitely want to hear about it. Here's it. Floor is all yours.
Nice to meet you guys. Happy afternoon. Actually, we had different wording here that I couldn't get past my comms department about the regulators. If you're a regulator here, we're a very nice team. This is my third year at ETHMilan. Happy to be back. Actually, I live here. This is my hometown, so it's the home conference. Means after tonight, I get to go and sleep in my own bed for all the people outside. Don't have the same. And we also have a side event tonight, so make sure that you register. So I'm here to talk to you about institutional vaults, which is a very, I would say, over-talked about topic in 2026, but it is one of the big things and big shifts, and I think a massive unlock for capital inside of actually crypto markets. So a little bit about my journey. This is, for me, year 15 building in crypto. Started when there was nothing. We ran around one of the first exchanges out of an apartment building in a beach town in Chile, and now we're running completely decentralized asset management on-chain. So that is a massive fundamental shift. The first 2 years here, I was actually talking about interest rate derivatives, and interest rate derivatives access actually gets us into on-chain asset management. So the protocol, IPOR protocol, now Fusion, has actually been running assets on-chain for the past 4 years. So we launched in 2022. And through building that protocol, we actually built a very early version of what we consider vaults, running a lot of different actually money market funds and interest rate derivative, basically an on-chain investment bank. And actually, the interest rate swaps will go into structured products on-chain through one click. So that's how we got to institutionals allocating on-chain. But when we talk about vaults, what we're really talking about is a new form of asset management. Now, asset management isn't something new. Asset management is actually quite old, and it relies a lot on trust and also a complete lack of trust. So what is asset management? You typically give money to someone, maybe someone's cugino, and they run strategies, they take your money, and you have to trust that they're going to do something with your money. They have someone looking over their shoulder, and the whole process is implicated around making sure that the person that you give your money to is actually doing what they're supposed to do, and that the strategy matches this prospectus. So that goes from custodial, where you deploy your assets into an account, the discretion of what this person can do with your assets, actually to the periodic reporting. Maybe you get a monthly, maybe you get a quarterly statement. That quarterly statement is calculated by a third-party agent and then is double-checked by an auditor. And then you have very opaque view into actually what's happening. And I think this is a little bit by design, because asset management isn't necessarily magic. It means that there are people that do it better than other people, but asset management it's a very commoditized kind of industry. So one of the reasons that you have this opacity is because you don't want to leak secret sauce. But vaults change the entire structure of on-chain asset management. You actually see, I think there were, Copper is announcing that they're trying to get acquired right now. There was another custodian that's getting acquired by another bank. So custodians, they hold your money in trust because you don't want to trust another third party. But for me, as a crypto native, I think the custodial role is a bit unnecessary. And in vaults, actually, it's a new paradigm. Vaults are non-custodial asset management, and this is something fundamentally different. If you deploy your assets into a vault, that vault, the smart contract itself, becomes the custody of the assets, and through a properly constructed vault, that can gate exactly what's happening. That can gate how the prospectus matches what's happening on-chain, and that can be verified by all parties. The other part is everything can be programmable. from the Vault smart contract to what it touches inside of DeFi, to the strategy, to the risk management. This can not only be programmable, algorithmic, but it can also be transparent. It can be transparent actually while maintaining intellectual property. So this is an absolute game changer. And instead of getting my NAV calculation in my quarterly report from my trusted asset manager, what happens if I can get my NAV calculation in real time, block over block, from the blockchain itself? This, again, is a fundamental game changer. And then in DeFi, you get default transparency. So you never have to guess where your assets are in the market. You can actually look on chain, or if you have a proper UI, then you can actually show where your assets are in the market. So it's not that vaults are an absolute game changer. It's not that they're making something new. They're actually taking something very old and they're making it that much better. And in making it that much better, they'll actually disrupt the industry and they'll probably put some people out of business. You have a lot of trust implications and people checking that may not necessarily be necessary if you have a fully fledged operational on-chain asset management vault, and that's why it is a game changer. Okay, so we're going to talk about 6 key pillars of what institutional allocators, what their compliance department, what regulators are asking for when they think about vaults as an asset management construct. So first of all, let's imagine that we're putting our money into a fund. That fund may have a prospectus. The prospectus describes what can be done. So how do you match this paper self-reported thing into this magic money box that's a smart contract interacting with different protocols, with different markets? This is a big question, but actually it can be answered. So in a properly constructed institutional vault, of course, I'm alluding to Fusion by IPOR, this should be actually answerable. So it should never be a question of what is the bounds of this smart contract, what can it interact with? This should be transparent from the markets to the actions to the individual assets. So this deterministic risk enforcement can actually be enforced on-chain at the smart contract level. So for example, if someone wants to execute outside of the bounds of the prospectus, the Vault smart contract itself will enforce these bounds. Again, this gets rid of the necessity to have some of these risk controls inside some of these asset management departments. Okay, the other is segregated failure domains. So everything can go wrong in any financial strategy. We know of all of the potential risks in DeFi. We know that there are hacks, there are different market risks, the liquidity risks. So the question is, how do we make sure that if something that's highly risky blows up, how do we make sure that it doesn't take out the entirety? So in a vault, actually, you can consider it segregated failure domains. Think of a vault as a hedge fund in a box, and every vault should have a completely different risk profile. It touches different markets, it has different leverage parameters, it has a different kind of algorithm to manage the strategy inside. So vaults can be segregated failure domains. You can spin up a single vault per user, a single vault per client, or a single vault that allocates for multiple clients. That can have a very clear, it can have a very clear trail of exactly what it can do in which market. So again, one thing that you need to make clear with your compliance departments, what can this vault do? Transparency and verification on blockchain is actually part of it's part of its greatest feature. So transparency and verification, when you issue a legal opinion, how do you know what the smart contract can do, and how do you know what it can't do? Again, we're talking about how you match this prospectus to the on-chain contract. So we built screeners on all of the Fusion vaults where you can see exactly what is possible in the vault, where your money is at all time, what it's yielding. And the transparency and verification, it actually makes it readable for all parties. Compliance as infrastructure is probably one of the biggest blockers, I would say, to institutions getting allocation on-chain. When people started building in DeFi, they didn't talk about what is allowed by law. They didn't talk about what's compliant by different standards across multiple jurisdictions. But if you want to get institutional capital inside, this is something that you have to think about. So one of the biggest blockers, especially for institutionals that are deploying other people's capital, is who's my counterpart? So the lack of KYC in most of DeFi is actually a big blocker. And it really depends on what your structure is. If you're structured like a fund, it's going to be a much bigger blocker than if you are more liberally structured like a family office, or if you're something like an ETP. But at a vault, you can actually gate who can interact with a vault through a whitelist. You can use blacklists. Even if you're doing a public vault, you can run it across screeners for OFAC sanctioned addresses. And in Fusion vaults, you can actually whitelist from the vault depositor level all the way down to the in-market level. And I think this will be a massive unlock in size for institutional capital. So what happens if you need to change a strategy? If you need to change a strategy inside a desk, you might have to send an internal mandate. You might have to get it changed by the compliance. But if you have algorithmic strategies that you're running at a vault level that are completely configuration-based, you can actually update the smart contract and the off-chain parameters, and it automatically interacts. So, for example, if you guys are familiar with DeFi and what's happening right now, there was an exploit of a protocol called Kelp, and this set off a chain reaction. That chain reaction meant that one of the largest protocols, Aave, had massive potential bad debt. So some of the infrastructure that we run inside of Fusion vaults allowed Fusion to be one of the first vaults outside of Aave, moving around 50 million completely out in a single flash loan, one atomic transaction, to safety. What did that take? It took a change of a parameter on a backend infrastructure that's running on a Fusion vault. So this is something that you can actually do 24/7 when you're trading on-chain. And so the first 5 things that we're talking about, the transparency, the controls, the KYC, all of this makes it easy for all parties involved, from sales and marketing down to the regulation, to your in-depositor, to the, sorry guys, to the, sorry. Okay, to the end investors that are putting money in your contracts. It's been a long day, a long week. Okay, so what we're talking about at scale, I think that asset management on-chain is an inevitability. One of the biggest blockers is the KYB and the KYC, but we're getting over that. So we have institutions right now that are deploying hundreds of vaults on our infrastructure. We've talked with the lawyers, we've talked with the compliance departments, we've talked with the regulators. And one of the biggest things that will be a massive unlock is something that's really scary, which is the hacking risk, the loss of funds, the risk of breaking anti-money laundering laws. So we build with max transparency. So Fusion vaults as a construct, they embrace the transparency that you get from on-chain. Everything can be verified by third parties. And this is powerful and it's important because this is going to be a massive unlock for also capital. All Fusion vaults are actually independently risk rated by a third party called Cerberus. Why? Because the entire risk surface of the vault is transparent. It's on-chain. So this allows you as a depositor, a fund that's deploying capital, a regulator, maybe someone like an insurance provider to verify what's the strategy from top to bottom, what are the second and third order consequences, what is everything that this smart contract touches, from the vault smart contract to the assets that it holds inside, to assets that it's lending against, to different failure mechanisms. And once you get the transparent verification of the vault smart contract, of the asset management, you get the risk rating, you get the insurance, this is where you start allocating in size. So just in March, we announced the collaboration, which we believe is the first of its kind. So through the block, we are working with Tesseract. Tesseract is a Finnish FSA MiCA regulated fund that's now deploying on our infrastructure. And one of the first partners there is 21 Shares, the massive ETP provider. So what it looks like, if you're thinking from the crypto native sense, is 21 Shares is the client, Tesseract is the curator, Fusion is the stack, and this is how they're allocating capital on chain. But the important thing is the MiCA license here, which unlocks institutional capital. So this is something that's starting to scale. They have 6 other clients that are coming in under this license, under this pilot. And so we're quite excited to see that because, again, we think that this is one of the biggest unlocks for DeFi in general, which is actually moving institutional capital into DeFi. For the past 2 years, we've had a lot of DeFi native capital that's been swinging around, farming incentives, not really becoming net positive. But the real unlock in terms of DeFi, in terms of market size, is actually moving bank deposits on chain. And we believe that this is the biggest net benefit to bring assets on chain. So these are some considerations that you need to think about if you are an institutional allocator, if you're a DeFi builder, if you're a vault provider, if you're insurance. And so our unlock of the MiCA compliance, it was painful. We went through about 6 months of talking back and forth with the internal lawyers, getting a legal opinion, talking with the regulators. But I think that this unlock is actually going to be very nice for different jurisdictions. We see funds that are actually pushing, we're seeing one bank actually push another. And so, yeah, I mean, institutional capital, I would never think that I was going to talk about institutional capital coming on-chain in a fully permissionless environment, but here we are. So I want to give just a couple minutes in case anyone has any questions, because vaults are a new thing, they're an old thing. There's every kind of vault out there, from vaults that are masquerading, they're a trust me bro hedge fund where you have massive trust, to something that's fully permissionless, trust minimized like Fusion. So when you're choosing your stack, I would choose, choose Fusion. Okay, good. Yeah, questions? Yeah, okay, so if you're thinking about like, so the recap is like, who are the players in a vault infrastructure? And okay, so a vault it's a smart contract, right? It's the non-custodial vessel that the funds go into. It becomes a way of connecting, executing, and standardizing that accounting and returning the assets to the investor, right? So the investor, whether it be an individual, whether it be a pension fund, is going to put assets into the vault and they're going to receive shares. The most important role, so I'll tell you about Fusion vaults, but every vault is a little bit different, but there's different standardized smart contract roles. So you can think of different fund administration roles actually mirrored in a smart contract. So in the Fusion vaults, we have the Atomist, which is like your asset manager. Your asset manager is choosing the strategy bounds. So we use these things called fuses to connect the vault to different markets. So think of it like, if you use a vault that's a Lind-only vault to Aave, you know that this is Lind-only and it's Aave. This vault can't trade perps, it can't take debt, example. And then you have this person that's basically constructing the on-chain investment universe of the vault, but they don't have control of the funds. They can't move the money to their pocket. So this is your risk management between the depositor and the asset manager. Now we have another role which we call the alpha. You can think of it like execution, or your execution role. That execution role can move the funds on behalf of the vault, where the vault is always the end owner, through different trades. So the executor is always bound in the smart contract by what the asset manager can do. So when I mean transparency, I mean, like, let's imagine that I'm allocating to a fully public vault. I can look at the Vault smart contract, I can see what are the bounds, I can see which markets are connected, and I can know who can do what, right? I even know that in that, if I know this address, is it an EOA? Is it a end owner address? Is it a multi-sig? Is it, so I can also go down in what are my risks in interacting with this vault, to understand, is there a hack risk where someone can reconfigure the vault and actually move money to their pocket? So there's a couple of different roles in the vaults, but it's really reconstructing like all the administrative controls that you have at a fund.
Any other question?
Yeah. Is Fusion a competitor to like Morpho and Aave, or you guys even build on top of Morpho? And if it's separated, why would an institution choose your infrastructure to build a vault instead of Morpho?
Yeah, so Morpho, I would consider Morpho more of the market layer, Aave as a market layer. Fusion is an abstraction layer up above. So think of it like, again, like hedge fund in a box. So for example, we have Yo protocol, which built a gold carry trade on top of Fusion. So that vault takes Tether Gold, XAUT, it deploys it at Aave, it borrows USDC, and then it leverage loops it into Yo USDC, returns the basis to gold. So something like that is something that you can't build natively on Aave, something that you can't build natively on Morpho. If you're building it as a fund, you can either interact with the individual smart contracts, you can interact with the individual front ends, or you can build the consolidated experience, which is the vault. So the vault does a couple things. It does connection, it does standardization of accounting, it has the different risk, the different administrative roles inside of the vault smart contract itself. So it's much more like a fund infrastructure in a box in multiple ways. I mean, like, for example, there's no really accounting standards across DeFi credit markets. You mentioned Morpho, you mentioned Aave. They have interest-bearing tokens. How many decimal points does it have? 16, 18, 8. So all of this idea of standardization, actually Fusion handles for you at the Vault smart contract level. It uses different kinds of connection. It actually is Fusion vaults are self-accounting. So if you deposit $1 into Morpho, if you deposit one USDC into Morpho, you get AUSDC. AUSDC is a transparent smart contract that has a floating market rate. It's earning interest, and anyone can call that. So why would you need someone off-chain to tell you what that's worth? So the vault actually knows its own balance in the in markets. And this is what I mean by trustless accounting. So we built Fusion for people that are building strategies on chain. Most of the other vault providers are discretionary asset managers that built something for themselves. And that's why they can't really be used by other discretionary asset managers, because they were building for their own processes. You can think of it very much like Morpho for asset management.
Awesome. Another big round of applause for Darren. And now we're going to keep the momentum high, because we're going to have Hendrik from Talex. So if you could make your way to the stage while we're just changing out a few things.